Netflix, we know, has gotten creamed, gotten destroyed. And they came out, something interesting, right? They came out, I didn't think the numbers were that good. I mean, there was some positives. They get into advertising. They hired Microsoft, which is great. Just the cash flow numbers are pretty good. But I thought it was a kind of weak number. You still saw the stock go up. It was up a lot more pre-market, right? So it was up 6%. Now it's up 2.5%. Market's like, iffy right now as we're doing this around 10:30. You guys are probably going to listen to this around 5 p.m., 6 p.m. Eastern Standard Time. But, what did you think about Netflix? I mean, there's a couple of takeaways I want to go over, but what did you think of the numbers?
I thought the price action was interesting. I knew that they had guided for a loss, and so I thought $2 million was pretty high. Overall, I think this is just a good lesson on what you say about how sentiment, investor sentiment, the mindset really drives stocks, because this isn't a company, we've talked about this in the past, this isn't a company that I'm really interested in or follow a whole lot. I like the big picture of it because, the next big streaming thing is always talked about, and there's such competition on streaming from Disney to Netflix to everybody else. It's obviously still way down from its highs, but the fact that their business model has changed from just spin, and we talked about this a few quarters ago, Frank, and they basically came out and said they're going to manage basically $10 to $15 billion, if memory serves me correct, in debt. And they're going to focus on margins, and they want to continue with content. I think the advertising thing is the biggest news. Is it starting in next year in 2023? They're going to have more advertisements. That's another stream of revenue. Mm-hmm. I think that shows the maturity of the business in a sense that you can kind of start to grasp it a little bit instead of just, hey, we have the next new show. That's great. What's next? It's always, what have you done for me lately? I think that's a maturing sign, the advertising revenue and that kind of stuff. But to their credit, they only lost 1 million subs. They were projected to lose 2 million, and now next quarter they're projecting to gain subs. I would have thought that everybody that had Netflix 2 years ago. That shows you what I know about the streaming thing.
It's funny because you'll look at their numbers and then you look at Disney with 130 million, right? And there's significant difference there. But the quarter wasn't that great, but it goes to what I was saying this week where, when expectations are the worst all time. When we're seeing sentiment indicators, the worst all time. I mean, we know inflation's here. Now we're able to see a lot of these risks. Now we're able to calculate. Now we know what the Fed's doing is working based on real-time data. We're seeing commodity prices get crushed across the board. We're still seeing inflation. I'm not saying that. But what we wanted to see is moderation, which means they're not going to go crazy and raise rates totally crazy. We're seeing what's happening is working, and they're going to go a little bit further. At the end, 8 days, they're going to raise rates probably by 75 basis points. And then we'll see what they do in September, which is going to be a question mark. I'd be surprised if they go more than 50 basis points. But you're seeing a lot of that stuff where the name is down so much. Expectations are down so much. You're looking at a name out of all the FANG names that this one's gotten, I think it's down the most out of everybody next to Facebook. This is down even more. But they did issue downside guidance too for $2.14 to $2.76. That's a big difference. But the $1 billion free cash flow this year is important because they're spending $17 billion on content. And what they said is that's going to stay constant. So it's always like 10 billion, 12 billion, 15, 17. Now it's going to stay constant. You're going to see free cash flow explode for this company. It's $1 billion this year. Some companies project $4 billion in 2 years from now and over $2 billion next year. So that's going to be great for the company with the free cash flow coming in. Now I want to look, and this is what I want this podcast today to be about, because you've seen a separation in stocks. You're looking at Netflix. Netflix is becoming a value stock. It's trading at 20 times forward earnings. When I look at Disney, Disney's trading at 25 times forward earnings. Some people may say 20 times forward earnings. Their earnings are expected to go 25%. I don't see that happening. People are expecting, remember last year they started reporting and they're like, everyone just did a reset. So they're like, oh, all right, we don't expect them to get back to pre-COVID levels this year now. It's going to be next year. Like, that's perfectly okay. It's like you just give up a year, right? We're going to suck for another year. We were wrong. All this isn't going to get great this year. We were wrong. So just draw out the year. And now we're just going to push all those, that target price of $108 for Disney, it's still intact, but it's a 24-month target now, which is, and I understand you have to look from the investment bank perspective, especially when they're not generating a lot of money on the investment banking side. But Disney's a company that has a lot of debt, more debt than any other time in its history, and they're going to have to take out more debt to compete if they really want to compete with the big guys who I think AT&T, which now Discovery, Disney, they're spending around $15-17 billion. That's a ton of money to Disney. Here's the big difference. Disney needs to shut down this Disney Plus business. They just came out and said, well, Hulu's the fastest grower. Hulu's been around forever and it's still losing massive amount of money. And last quarter, that's over $800 billion if you're looking at for streaming, for the division. It's going to continue to lose money. And the biggest thing, I know, and this is why you're seeing so many bots on Twitter, Daniel. This is why you see so many bots on Facebook and all these fake accounts and stuff, because everybody was looking at these companies as the one metric. There's always a metric that people look at. And sometimes it's not earnings, sometimes it's not sales, sometimes it's whatever. Sometimes it's same store sales. With a lot of these platforms, it's always about subscriber growth. And Facebook magically has always been able, because that's why they took over Instagram. That's why, it's just the more and more companies that they were able to take over. Yeah, they were able to get to 3 billion, close to 3 billion. No one thought they would even come close to that number, but that was a number everyone's looking at Facebook. In the meantime, Twitter, they slowed, but they found a way to monetize. And this was like 3 years ago, where they slowed in terms of ads, and the stock got nailed. So now what does Disney do? Disney goes, all right, we're going to add hundreds of millions of people to this platform. And everybody loved it, right? In the meantime, they're like, wow, this is the greatest strategy ever. It's not the greatest strategy ever. They were forced to do this because they were hurt more than any other company during COVID. Every one of their businesses, you look at theaters, you look at movies, you look at the parks. I mean, it wasn't just like COVID vaccines. These things, it took 12, 18 months, and still they're not at 100% capacity in the parks. So yeah, it was a big shift. And they said, wow, here's a way to generate money, and maybe we'll get a multiple like Netflix. Well, your multiple in Netflix is 20 now, and you're at 25. So if you want Netflix multiple, it means you got to come down. But look at average revenue per user, because at the end of the day, it's how much money you make, especially in a recession when you have rates going higher. So if Disney's going to look to spend just as much money as their competitors, they're going to have to take out debt. Debt is much more expensive than it was 6 months ago, a year ago. But their average revenue per user is $4.35. Okay, and whatever they have, 135 million subscribers. They say they're going to get to 230 million in 2 years. The more, I hope they don't. The more subscribers they add, the more money they lose. So their average revenue per user is $4.35. What do you think Netflix is? Do you have any idea, Daniel?
Just based on that, I would guess like 7 or 8. $12.
Oh, damn. Yes. And now you're getting into the advertising model, right? So for me, which one do you want to buy? You can say, well, Disney parks are great. It is great. That's their business, marketing, theaters, movies. Why not license your content to all these people who are dying for content? Why did you get into this business? I understood why you got into it, but now it's like, it's a stubbornness that, hey, we're all in this business, so let's just go in. We said 230 million subscribers. The more subscribers they add, the more the average revenue per user is going to go down, and they're going to get crushed. They'll never make money on this division ever in history. They won't make money on this division, ever. They won't. They can't. Not at this business model where we just sign up subscribers and giving it away for free, which they're doing. So if Disney gets out of this and starts licensing their content, now they become a massive free cash flow machine. But they're fortunate to have all these other businesses that are booming right now compared to Netflix, which is totally tied to streaming, and maybe they get into gaming, and now it's in advertising where they're playing catch up. You see this sinking ship, and Disney keeps going all in on a market that's pretty much in a secular decline now. And that's where the strategy has to change, and it hasn't changed.